Hedge funds. They're one of the most exclusive and elusive investments in the world, known for their high returns, complex strategies, and a certain air of mystery. But what do the wealthy know about hedge funds that most people don't? Welcome back to channel name. In today's video, we're peeling back the layers on hedge funds to explain why they're such a favored tool for high net worth individuals. If you've ever wondered how hedge funds work, why they appeal to the ultra-wealthy, and how they fit into sophisticated investment portfolios, then stay tuned. Let's dive into the world of hedge funds. What is a hedge fund? Hedge funds are pooled investment funds that employ a range of strategies to generate high returns, regardless of whether markets are up or down. Unlike traditional funds, hedge funds have more flexibility in the investments they make, allowing them to use leverage, short selling, derivatives, and other high-level tactics. In simpler terms, hedge funds are designed to hedge against the market by using unique strategies to maximize profits while reducing risk. They're typically only open to accredited investors, which means that hedge funds are exclusive to high net worth individuals and institutions. Each hedge fund has a fund manager who oversees the investments. They charge high fees, typically a 2 and 20 feet model, 2% of assets under management as a management fee and 20% of profits. While this fee structure might seem steep, many wealthy investors see it as worth the price if it means getting access to top-tier investment talent and strategies that can perform in volatile markets. Why high net worth individuals invest in hedge funds? Hedge funds offer something that's incredibly valuable to high net worth investors: the potential for high, uncorrelated returns. Hedge funds aim to profit even when traditional markets are down, making them attractive for those who want a diversified portfolio. For wealthy investors, hedge funds can serve as a counterbalance to traditional investments. With the right hedge fund, investors get access to unique strategies and markets that aren't available through standard mutual funds or ETFs. Many hedge funds are known to outperform traditional asset classes over time, providing both growth and protection, two things high net worth investors prioritize. How hedge funds work. Seen detailed animations of investment strategies, such as short selling and leverage. Hedge funds differ from typical investments in how they approach markets. Their strategies are designed to capture gains in both up and down markets, often using advanced financial techniques. 1. Leverage. Leverage is the use of borrowed capital to increase the potential return of an investment. Hedge funds can amplify their buying power by borrowing money, allowing them to take bigger positions and maximize profits. However, leverage is a double-edged sword. While it can lead to high gains, it can also result in significant losses if things go south. This is why leverage is typically used selectively and strategically in hedge funds. 2. Short selling. Short selling involves selling borrowed stocks with the hope of buying them back at a lower price. Hedge funds use short positions to profit from declining stock prices. By shorting stocks, hedge funds can profit even in bear markets, making them appealing during economic downturns or recessions. 3. Derivatives and arbitrage. Derivatives like options and futures allow hedge funds to create sophisticated strategies that manage risk or speculate on price movements. Arbitrage, meanwhile, takes advantage of price differences in different markets, profiting from small fluctuations. These strategies are highly technical and require skill, but for wealthy investors, they offer an edge that traditional investments simply can't match. Different types of hedge funds. Hedge funds come in many forms, each with a unique focus and strategy. Let's look at some common types that wealthy investors gravitate towards. 1. Equity hedge funds. Equity hedge funds primarily invest in stocks. They may focus on long positions in promising companies, while shorting companies expected to decline. These funds are ideal for high net worth investors looking for a more aggressive stock strategy, with downside protection from the short positions. 2. Macro hedge funds focus on global economic trends, trading currencies, commodities, bonds, and equities based on worldwide events. For wealthy investors, macro funds offer a way to profit from major economic changes. They're especially popular during times of uncertainty or market upheaval. 3. Event-driven funds. These funds look to profit from specific events, like mergers and acquisitions, corporate restructures, or bankruptcies. They aim to capitalize on price changes resulting from these events. Event-driven funds are a favorite of high-net-worth investors because they often yield strong returns regardless of the broader market's performance. 4. Quantitative hedge funds. Quantitative or quant funds use complex mathematical models and algorithms to guide their trading decisions. They rely on data and AI to identify patterns and execute trades. For tech-savvy high-net-worth investors, quant funds represent the cutting edge of finance, blending data with investment strategy to try to outpace the market. Risks and rewards of hedge fund investing. Hedge funds have the potential for high returns, but they come with risks. Let's explore both sides. On the reward side, hedge funds offer the potential for outsized gains, especially in turbulent markets. For high-net-worth investors, this can mean big returns even when the economy is struggling. However, hedge funds also have drawbacks. They're illiquid, meaning you often can't withdraw your money for years. They're also high risk. Some hedge funds lose substantial amounts when strategies don't work as expected. It's a high-stakes game, but for those with the appetite for risk, the rewards can be significant. How to get started with hedge fund investing. If you're a high-net-worth individual looking to invest in hedge funds, here's how to get started. The first step is to meet the requirements. Hedge funds generally require you to be an accredited investor, which means having a high income or significant net worth. Next, do your research. Look for funds with strong track records, experienced managers, and strategies that align with your investment goals. Consult with a financial advisor who has experience with hedge funds. They can help you understand the nuances and ensure you're making an informed decision. Conclusion: hedge funds are one of the most powerful tools in a high-net-worth investor's arsenal. With the potential for high returns, unique strategies, and access to exclusive markets, it's no wonder they're so appealing to the wealthy. But hedge funds also come with risks and high fees, so it's essential to weigh these factors carefully.